Hello students, let's start bad debts and allowance for doubtful debts topic. Bad debts written off. Whenever the business is confirmed that it will not be able to collect outstanding debts from its credit customers, like the debtors, so the debts become bad. Therefore, there is need to be write it off as an expense in income statement. Okay, so double entry to record bad debts is debit bad debts and credit accounts receivable, because when we first created the entry, when we sell the goods, we used to debit account receivable, but now it is confirmed that we will not gonna receive the amount, so we have just credited the account receivable. Okay, so what will be the effect of this transaction? The bad debts is expense and it will hit the income statement. Okay, and account receivable is the current asset, so it will hit the bank balance sheet. So whenever the business is confirmed that it will not be able to collect outstanding debts from its credit customers, that is debtors, so the debt become bad. Therefore, there is need to write it off as an expense in income statement. Double entry to record bad debts to written off debit bad debts and credit accounts receivable. The effect of this transaction is bad debt is an expense and it will be in the income statement. Account receivable is a current asset and it will be in the balance sheet. So now the allowance to doubtful debt. What is the allowance to doubtful debt? In this case, the business is not confirmed that how much money it will not be able to collect from its credit customers. Like they are not sure how much they will gonna collect. So the business makes estimations. So the double entry to record allowance for doubtful debt in the first year of trading, and whenever allowance increases is bad debt debits and allowance for doubtful debt credit. Debit the bad debt account and credit account allowance for doubtful debt. So the entry will be profit and loss account debit and allowance for doubtful debt credit. Okay. Now the effect of this transaction is profit and loss account expense income statement. It will hit the expense in the profit and loss account. Okay, and allowance for doubtful debt subtracted from account receivable. So we will gonna subtract it from the accounts receivable, because when we first created the entry, when we made sales on credit, we used to debit the account receivable and credit sales. Now we are not sure that we will gonna receive the money, so we will subtract it from the account receivable and it will hit your balance sheet. So double entry to record allowance for doubtful debt, whenever it decreases, if it decreases in future, like you're gonna receive the money back, so allowance for doubtful debt debit, like the reverse of this, the previous entry, allowance for doubtful debt debit and profit and loss account credit, it will add up. So effect, like profit and loss account, revenue, income statement, it will add up again the amount whatever you will gonna receive, allowance the same entry. So there are different names like allowance for doubtful debt, provision for doubtful debt. You will see these terms vice versa.